Good morning. Welcome to AmericaFirst Wealth Management Investment Outlook Podcast for the week of August 19th, 2024. My name is Dan Liu. I'm the Chief Investment Officer and Portfolio Manager at AmericaFirst Wealth Management. And joining me today again is Michael Cheah, our Head of Fixed Income and Portfolio Manager. Welcome, everyone. Next slide, Mike. This is our standard disclaimer. I'm not going to read this. Just basically saying that we're expressing our views and not giving any investment advice, and our views are subject to change as market conditions change. Next slide, Mike. So what we like to do is to start off with our conclusions first, because this can be a lengthy presentation because we do have a lot of data to talk about. So let's get our conclusions up front. So for those of you who want to listen further, we have a lot of supporting information and details. But my conclusions for the week are that equity valuations are indeed high, but the third quarter earnings and sales growth outlook by analysts actually look okay. The macro environment is troubling to me because overall interest service as a percentage of tax revenues by the United States is potentially becoming unsustainable. The key events of the week will be Wednesday, 2 o'clock, FOMC will release their minutes. And on Friday, 10 a.m., Chairman Powell will be giving his Jackson Hole speech. So those are the key events to watch for the week. Next slide. We're all talking about politics, obviously, here because it is the presidential election season. And I have been asked in the past, which political party has been associated with better stock market returns? And if you look at 1928 to 2023, the Republican Party has been associated with positive returns 43% of the time, and a Democratic Party, where the president was a Democrat, was associated with 57% positive returns. So from this associative information, it's clear that Democrats have been associated with positive returns for a majority of the time. However, what's more important are positive earnings growth. 67% of the time, when there's positive earnings growth for the S&P, that's been associated with positive returns for the index. And 33% of the time, when there's negative earnings growth, only 33% of the time have we seen positive returns for the S&P 500. So while party might be important, far more important is earnings growth. Profits matter than political party. Next slide. So I mentioned before that stocks do appear to be overvalued. This is the S&P 500 forward 12-month PE ratio for the past 10 years. And also plotting on this chart are in the green dashed line is the average 5-year 12-month PE, the PE for the 5 years on average. And then on a 10-year average is the dashed blue line. So we're above the 5 and 10-year average for the forward S&P PE ratio, which is why we are saying that stocks are a bit overvalued here. Next slide, Mike. This is the, as reported by FactSet, the S&P 500 earnings growth year over year on the top chart. And this is by economic sector, and on the bottom is the revenue growth. And for the third quarter, analysts are looking for a fairly robust 5.2% earnings growth and a 4.9% revenue growth. And you can see that the key sectors for earnings growth are information technology, healthcare, communication services, and real estate. And it peters off from there. And on the revenue side, information technology, communication services, utilities, and real estate are exhibiting the highest revenue growth. But overall, it does look like analysts are projecting for growth. So despite the high valuation, with earnings growth, it can portend continued positive returns for the S&P 500. Next slide, Mike. As I alluded to, it is concerning on a macro basis that U.S. interest payments, this is on the top chart from January 1990 to July 2024, U.S. interest payments, interest payments on the bottom and tax receipts on the top. And what this suggests is that the 1.1 trillion in interest payments on the numerator as percentage of the tax receipts of 3 trillion on the bottom, we're approaching 40%. And this is likely to be unsustainable, and there needs to be some adjustments. Either interest rates need to be cut, fiscal policy needs to change to drive higher tax receipts, either through tax increase or stimulating economic growth, which would also yield higher tax receipts. Next slide, Mike. Or fiscal spending needs to be cut. Government spending being cut would hopefully reduce future burden on incremental bonds and higher interest payments. This chart was kind of interesting because the gold line, which is showing where you see the two dots, assuming a 200 basis point Fed cut, even if you have a dramatic Fed cut, interest rate cut like that, interest payments would still rise to 1.2 trillion from 1.1 trillion currently. And if interest rates were not cut by July 2025, interest service payment would rise to 1.4 trillion. So this does suggest that interest payments will still be very high, even with a dramatic rate cut. That might stimulate growth, hopefully to increase the tax revenue side, but there will be no significant reduction in interest and debt service if rates were to be cut dramatically by the Fed. Next slide, Mike. On Friday, we had one negative surprise. Obviously on Wednesday we had a positive surprise with the retail sales, and that's what dramatically sparked the rally in the markets. But I wanted to focus on the Friday announcement. Single family starts plunged below 70,000 in July. It's a very poor number because despite the drop in the 10-year bond rate, we were hoping, as I mentioned last week, that housing starts would increase. But the fact that they plunged, the lowest single family start number since the spring of last year, this is a very recessionary sign and something to keep an eye on. Hopefully we'll see this turn around with the next housing starts number. But if this housing start number continues to persist, it'll lead to a drop in construction payrolls, and that will clearly be a recessionary factor. Next slide, Mike. Quickly turning to weekly market stats, obviously with the strong retail data on Wednesday, sparked a pretty strong rally across the board. I'm not going to dwell on these numbers. Viewers can ask for these slides or just they're noted here. Next slide, Mike. Treasury yields, again, they are following the 10-day moving average quite well, and that's why we continue to show it. We had a 5 basis point drop during the week, and we're pretty much flat with the beginning of the year. So it's a pretty important moment because we're really testing the beginning of the year interest rates. So whether we see a jump or a continued decline, I think will be important to see what the next week or two shows for the 10-year Treasury yields. Next slide, Mike. The yield curve, the blue line shows the yield curve ending Friday, and the orange reddish line shows the beginning of the year, and the top curve shows the end of the second quarter in June. What's interesting to note is that at the short end, the current yield curve is now under the yield curve at the beginning of the year, but at the longer end, it's still higher. So clearly there's more drop at the short end than at the longer end. So that's kind of an interesting shape. It's still inverted, which, as we know from the past, has been a sign of a potential recession. But let's see what happens. The market is pricing in for rate cuts in September, but even then, we'll probably still continue to see inversion on the yield curve. Next slide, Mike.
All right.
Turn it over to Mike here. Yep.
Thanks, Dan. My conclusion is number one, we are seeing more data saying that the economy is not in a recession yet, right? So given that, is it necessary for the Fed to cut rates? My thinking is probably not, right? But as Dan mentioned, we'll take the hint and the clue from the Jackson Hole meeting this coming Friday. However, the market is pricing in a lot of Fed easing, so we are prepared that the possibility that the market may be disappointed if the Fed do not do what the market is expecting. So first off, if you look at the ISM services PMI, we are above 50, right? And if you look through the last year and a half data, we are above 50. That means that the service side of this economy is expanding. We had 3 months of contraction, but in general, the service sector is expanding, right? And this is where wages is important. Wages is important because the service sector tends to employ a lot more people. And looking at the New York Fed econometric model, they call it in nowcast, and they update their model live whenever we have a new set of economic data, right? And for Q3, real GDP, their model is now looking at 2.24%, higher than the previous estimate of 2.11%, right? So question then is, where is the recession? Where is the recession, right? 2.24 is interesting because this relates to the potential GDP, right? The speed limit of this country. It has been estimated by the Congressional Budget Office that the potential GDP is now running at 1.8%. 1.8%. So at 2.24%, we are running above our speed limit, meaning that there is sufficient and sustainable inflationary pressure on the economy. So though the economy is not getting any rest at all, right, in order for inflation to be on a sustained level, to be coming down on a sustained level. And business investment is accelerating, right? A large part of this is obviously due to reshoring. Companies are being more conservative on their supply chain, and so building factories, and this require labor, right? And meanwhile, look at the corporate balance sheet in terms of the income and expenditure, very strong. So companies have money to invest, right? Companies have money to invest, and clearly the CEOs are not going to invest if they think that the economy is going into a recession, right? And here, very clearly, after the panic about a year ago, here you have S&P 500. Number of times the word recession was mentioned in earning calls. We are down to almost zero. Okay, all right, almost no CEO talking about recession, right? So the reality of recession compared to what the equity market is expecting is a huge difference. Right? And Dan mentioned about the retail sales. And here we see retail sales on a nominal basis very strong. If we take out inflation, it is also very strong, right? So here we have companies are investing, consumers are spending, and I think the economy looks fine. I think the economy looks fine, right? And share of firm discussing layoff on earnings, like has also declined and remained low, right? So we cannot have a recession until the companies fire the fire workers, which we also say when they fire the customers, right? Because when they let go workers, high unemployment means that less people are buying things and revenue drops, right? So we are not there yet. Inflation, yes, we have good news. Looking at the New York Fed 3-year consumer expectation, it has dropped to the lowest level since inception. Right, very good news. And the problem is that it's not entirely clear sailing because we see that the wage growth is bottoming up here after a huge decline. And if you squint your eyes, you can see that the higher wage sector has started to turn up, right? So we still have a shortage of labor, right? The unemployment rate is still too low, right? So as I was saying just now, the market again pricing in more Fed cuts in the next 12 months, and this is looking at 2% cut, which is a lot. It's a lot, right? Considering the economy is still very strong, right? So yes, the good news is that inflation has come down, right? But not quite to the Fed target. So if the Fed were to cut rate, according to what the market is expecting, then the economy is going to accelerate even further. It's really strong. It's really strong. The economy is not weak at all, right? The Fed cut rate, this thing is going to shoot up, and whatever gain we see in inflation is going to turn around quite rapidly. So would the Fed want to do that? Well, meanwhile, the bond market, given how yields have come down quite sharply, the speculative accounts are once again very short treasury futures, betting that rates will go up. A large part, I think, would be more and more supply to the market. Dollar, like, last week I talked about the yen carry trade, and I just want to add a new chart. This is showing that net 63% of the fund manager survey investors still believe that the yen is undervalued. Right? So this means that there's still a lot of unwinding there's not a lot of carry trade to be unwound. Right? The question then is when will the Bank of Japan raise rate again? Finally, something is happening here. Something is happening here. central bank is holding gold at the fastest pace on record. So we know that gold price has hit an all-time high, and central banks are now buying at a more frantic pace. So something is happening here, and I'm watching out for the dollar very closely because typically when gold price goes up, and that is led by foreign central banks selling treasuries to buy gold and basically moving out of dollar. So if the dollar were to weaken sharply, that could change a lot of the scenario that we're looking at. All right, Dan, back to you.
Okay, you found mute there. Mike, I just want to ask you a question on
Yeah.
gold.
Yeah.
The rise in gold, how much do you think is based on the expectation of interest rates declining versus inflation concerns versus central banks just selling US treasuries and dollars and wanting to increase their reserves in gold? Obviously, those typically tend to be the three factors that are under consideration for central bank gold buying, or is it simply a subject of a new long-term reserve policy to hold more gold?
Yeah. I think all this goes back to the Russian Ukraine start of the Russian-Ukraine war, right? Where the U.S. government freeze the Russian dollar asset, and that started the move where BRICS become more agitated, and the BRICS nation wanted to basically uh, safeguard themselves from any possible freezing of their dollar asset. So they, as a group, have started talking about number one, invoicing trade away from dollar into something else, anything but dollar, right? So we have a movement towards global trade pricing in Chinese renminbi, even in the, Malaysia is talking about creating something called the dinar, right, to be used among the Islamic countries. So that's number one. Number two is basically shedding their dollar-based asset, which is treasury, right, into gold, right? So the important point is that this is a huge geopolitical move, and will this country turn around and say we have enough gold, let's sell gold, right, and take profit? No, that's not the way they operate. They are not running a hedge fund, right? And the important thing also is that, like stock buyback, the gold that are bought by central bank are shipped away from the market here. They are shipped to Beijing, they are shipped to Singapore, and they are locked away from the free flow. So, so I see this as a very strong signal. And the question then is, at what time period do we see a major tipping point in the dollar? You know, same story as the frog in the boiling pot, right? It's comfortable, comfortable, comfortable. Nobody's talking about it, and then we see this exponential spike in gold.
Yeah, yeah. It's interesting. I remember when
That's the dollar.
Yeah.
Sorry.
I remember when gold crossed $1,500 an ounce, and it was a big deal. People were talking about it. There was a lot of interest, and it was all over the news. And now we're over 2,500 an ounce, and hardly anyone's talking about it. And most people aren't even aware that
Yes.
gold has crossed 2,500, and many investors have no idea how to invest in gold. So it's kind of interesting. We're watching the gold mining equity stocks, equity companies, and even those stocks don't seem to have reflected the dramatic increase in gold prices. So I think quite interestingly, gold mining stocks do look undervalued because of those factors I mentioned. So we'll see if the gold price remains sustainably high and continues marching on, so especially after the election.
Mm.
We'll see what happens then. But I think it's unique and nice that you and I do talk about it. We both have the experience and history of tracking gold. Certainly myself since the late 90s where I first got involved, and I'm sure you've been following it. In the late 90s, gold could have been purchased for under $300 an ounce, and now we're over $2,500 an ounce. So it's pretty interesting, quite dramatic.
Huge move.
Yeah, I guess that makes us an old timers or OGs, but just having that perspective and history helps us to understand what might be really happening in the world. Okay, next slide, Mike. Continuing on. Magnificent Seven, nice to see a turnaround this week after a couple of weeks of negative weekly returns. I do want to note that NVIDIA reports at the end of the month on the 28th. So that'll be a very important stock to follow. I'm going to call it the AI bellwether stock. We do have a couple of, I think Palo Alto Networks reports this week, which is involved in the AI network space. So that's going to be some insight into the demand in the AI space. Next slide, Mike. It's just the sector performance. Obviously, the no surprise with the strong market. Technology is a leader, followed by consumer discretionary. Obviously, strong retail sales drove that. I do want to point a note of caution because there was a lot of discounting that occurred in June, especially online. So if obviously if consumers were taking advantage of those discounts, that could be taking away sales that normally would have occurred in the future. Typically, during the month of August, the back to school sales could have been accelerated into the prior month. So watching for potential dip or sustained increase in sales in August will be quite important. It's nice to see all sectors recorded positive returns. Real estate sector being obviously at the bottom due to the sell-off on Friday with the weak housing starts number. Next slide, Mike. Factor performance, all positive as well. Everything was up. It was a good week. Pretty much across the board. If you held pretty much anything, you probably would have made money. Among the factors, IPO names, private equity names, high quality, were the best within style, momentum, and growth. High dividend stocks were also number 3. So it was across the board and was quite robust. It was good to see that. Next slide, Mike. Commodities, energy was kind of a mixed bag with the liquid energy commodities, ethanol, Brent, crude, and also coal not being liquid, obviously. Those are positive for the week. Natural gas was flattish. Heating oil and gasoline were down. Gasoline declining is also good for the consumer, obviously. And we're seeing a decline in gasoline quarter to date of down 7.9%. So that's definitely a good sign. And we normally should expect gasoline to drop as the summer driving season comes to a close, and we are in towards the end of August here. So we should continue to see gasoline prices drop, and we'll probably see a pickup in heating oil as refineries shift to manufacturing heating oil versus gasoline. Precious metals at the bottom, you see led by silver. Gold was also up. Copper prices rebounded, as did aluminum. Steel is still lagging and not seeing much growth there. So a good sign that construction activity is weaker due to the drop in steel. Could also be some shifting, particularly in the auto sector, going to lighter weight aluminum versus steel in manufacturing. Next slide, Mike. Moving on to agricultural commodities. Coffee has been very strong, up 30.3% for the year to date, and up strongly over 5% last week. Pretty much everything else was down. Lumber being the only agricultural commodity that was up for the week. That hopefully will translate into lower food prices for the consumer, which would be a welcome relief, because consumers tend to feel perceived higher inflation when food prices are higher. So that will hopefully support improved consumer sentiment and spending in other areas. Next slide, Mike. The economic calendar is kind of light, Monday and Tuesday. I won't comment on that. Next slide, Mike. I mentioned that we do have the FOMC minutes on Wednesday at 2 o'clock, which will be important to see what the minutes have been reflecting regarding discussions at the prior Fed meetings. Jackson Hole Symposium starts on Wednesday. Next slide, Mike. It's Thursday, manufacturing data, jobless claims will be important to look at. And existing home sales coming out on 10 o'clock on Thursday. That'll be important because existing homes will be reflective of people wanting to purchase existing homes or selling. And that's been kind of a sticking point because a lot of homeowners have benefited from locking in low mortgage rates. Seeing some movement on existing home sales would be positive because it's showing that people are willing to finally increase the supply of homes for sale, and willing to sell, even though they may have a low mortgage rate. And yeah, that's kind of it for material information on Thursday. Turning to Friday, Mike, next slide. And the important item will be Powell's speech at 10 a.m. New home sales will also be at 10 a.m. And that's pretty much it for the week in terms of macro data. And turning to S&P 500 company earnings. Next slide, Mike. Some consumer and some technology names. Estee Lauder, Palo Alto, Lowe's will follow Home Depot's numbers last week. Looking for Dow earnings on Lowe's, and then additional consumer names, Target and TJX will be important. They're looking for up earnings. Next slide, Mike. And then pretty much ending the week, pretty much nothing after Thursday. Relatively light earnings calendar. As I said, the Wednesday, Thursday economic announcements will be important, and will also be this week. I'll be spending some time kind of dissecting where consumers have been spending their money. The retail sales increase was a surprise to me in particular. So I just want to see where consumers were spending their money. Obviously, not in buying new homes, which we saw the Friday numbers. But we'll see where consumers have been spending their money and see if we have some insight to report back next week. And with that, next slide, Mike. As always, if anyone who's following our calls would like additional information, copy of the slide deck or any data, or to schedule a one-on-one call with Mike or myself or both of us, One of the things that we like to enable our investors and potential interested investors is to get to know us a little better, get to understand the level of information and depth and experience that we have. Our team, Mike, myself, and Jim Monahan, we collectively have over 100 years of experience. We've seen a lot of these cycles. We know how to look at the markets and look for areas of opportunity. We'd love to share that with our clients. We'd love to hear your concerns and interests, and also if anyone's interested in our products or services, Cleveland is the right guy to contact. His information is listed here. So feel free to reach out to us. And with that, I'll let Mike add if he's got anything to mention today. If not, I'll be signing out here. And thank you and have a great week. Mike, anything?
No, I just always we're happy to help. So let us know how we can help.
Okay. Take care.
Okay, bye-bye.
Bye-bye.